Welcome back. With a decent degree of market volatility, investors are looking for safe places to put their money. One option, of course, is the bond market, which remains a mystery for many. To help unpack the sector, let's go to Thomas Urano. He's managing partner at Sage Advisory. Thanks for joining us today.
Hi, thank you.
So American markets have been digesting weaker economic data over the past few days. How have you seen this affect the bond market?
So there was a significant change in bond market expectations for policy rates, starting with a non-farm payroll adjustment we saw. That followed in with some ISM services employment numbers that were weak. ISM manufacturing employment numbers are weak. So I think there's been a significant sudden recalibration of how the bond market's thinking about the economy, in particular the labor market, and some rolling into some weakness in that area.
Most of that prompted, you think, by the revision of the payroll numbers in the U.S.?
Yeah. Looking at revisions of payroll numbers, that was a significant revision, the largest we've seen since COVID. But also kind of looking at payroll numbers over the last 2.5, 3 years, the revisions have been almost persistently negative. So I think the market has gotten to the zone of thinking, the strength in the labor market that's been perplexing a lot of people. Maybe that was more of a methodology issue. Maybe the methodology for counting those labor numbers post-COVID needs to be adjusted. But I know there's been some concern around that. And that's led the market to price in significant rate cuts. If we jump to policy for a moment, we were, questionable on any rate cuts this year, and that's something that turned into over 2 rate cuts by the time we get to the end of this year.
Yeah, I was going to say, what fluctuations are you seeing as a result of the stronger support or opportunity of a rate cut?
Right. So, the market's gone from an expected cut in September, another cut in December. And oddly enough, there's about 2.5 cuts priced into the market at the moment. So that would imply some potential for short-term rates maybe getting a little bit ahead of themselves. I don't think 3 rate cuts. I don't think a September, an October, and a December rate cut cycle are in the cards. Could the Fed cut 50 basis points coming up out of the gates? They could. They did last year. But given Powell's commentary over the last several months, I don't think that's in the cards, which leads maybe the 2-year note a little bit ahead of itself. But again, as we get into the end of the year, you're only 6 months away from a new Fed chair. And at that point, you should feel pretty confident that the administration is going to appoint a chairman who's going to be fairly dovish. So you should expect further rate cuts to come along. And that, I think, leads the yield curve a bit lower. So 2s, maybe a bit ahead of themselves at the moment, but pushing lower as we get toward the end of the year. And I think that takes the long end of the curve a bit lower too.
What would be the biggest headwind at this point for bonds?
So I think one of the risks in the marketplace is Treasury supply. That's going to be one issue, right? And the concern is that a rising federal deficit is going to force the Treasury to increase supply in the bond market, in particular 10s and 30s. Now, we just had a cycle of 10-year issuance yesterday. Wasn't the strongest participation rates by foreign investors in that space. So I think one of the concerns the bond market has is if the Treasury needs to increase Treasury supply in the coming quarters, what will the demand be like? And is that going to be a concern? The other issue is inflation risk, right? Tariffs are not going away, right? So the market is still holding on to this notion that tariffs are going to drive inflation, and that could put inflation premium on the long end of the curve and cause some kind of bear steepening.
Yeah, and today being sort of day one of the new tariff rates for many countries around the world. So what is your view then on equities, considering the optimism, enthusiasm we have seen from investors since the bounce back in April?
Yeah, so a couple things. Number one, I think in the equity space, listen, we've seen a tremendous recovery here. We're going into weak seasonal, so the August-September timeframe historically are a little challenging for the equity market. But on the optimistic side, if we think about the new tax bill that was passed, it's stimulative, right? So I think the policies that have been put in place, if you take the inflation component out of that, the policies are designed to try and promote growth in the economy. If that's the case, maybe we can get through a little bit of a weaker seasonal period here, but end the year on a stronger note.
If you are looking at it through the eyes of legislation, what would be the timeline for any of that benefit to come through?
Well, listen, it takes a little bit of time here, right? I think some of the benefits out of the bill are designed to drive investment, and that's exactly what we need. But as you make CapEx investments, it takes a little time for that process to to go from the spend to the build out to the hiring and ultimately kind of increase in labor. So, it's a several quarter thing. This isn't a 2 or 3 month issue, but I think structurally the bill was designed to promote further investment in the U.S. and CapEx spending in the U.S. And we're going to need that. We're going to need that particularly in the technology space. We're also going to need that significantly in the energy and the utility space, energy production. That's one area where the bond market has been seeing significant supply in issuers who are coming to market to borrow money. Data centers, a lot of data center issuers are coming to market to borrow money to do that build out and that construction. So that CapEx, again, I think sets the stage over the next year or two in order for those particular industries to grow. Okay,
so then what would be your fixed income strategy, or what would your portfolio look like right now?
Right. So, what we've seen is a lot of investors who have been holding on to cash, still sitting in money market funds, looking at that yield, and still looks quite attractive, right? But as we get through a cycle of Fed cuts, that yield's going to go away very quickly. So the question is, what do you do? Do you sit in cash and money market funds? I think if you do that, you're going to be disappointed as you realize yields fall and your income disappears. How do you offset that? Think about moving further out the curve. And by that, I mean, maybe look at a core bond allocation. You're going to have exposure from front end all the way out to 30-year paper. But that average mix may take your maturity to, 5 to 7 years. And I think that's the type of exposure you want to have in your fixed income portfolio as rates are falling. It gives you an opportunity to hold on to yield longer. It gives you an opportunity to participate in some upside capital appreciation in bond prices if yields do fall. So I think the environment that we're going into from a policy standpoint over the next 2 years are going to be very favorable to a core fixed income strategy.
Thomas Urano, I've got to leave it there. Thomas is a co-chief investment officer, managing partner at Sage.